Right now, a lot of investors are staring at their screens asking the same question. What just happened to gold and silver? In less than an hour, prices dropped sharply, wiping out billions in market value across metals and related assets. For some people, it felt like the floor disappeared beneath their feet. If you were watching the charts live, you probably saw a cascade of red candles and wondered whether this was the end of the rally or just a violent correction. But before jumping to conclusions, we need to slow down and look at what actually happened, because markets rarely move without a reason, and the explanation is usually more mechanical than dramatic. Today, we're going to break this down step by step. What triggered the drop, why it spread so quickly, and what experienced traders were watching while everyone else was panicking. And by the end of this video, you'll understand something most investors overlook. When markets move fast, it's rarely random. The first thing to understand: speed doesn't mean chaos. When prices fall quickly, it feels chaotic. But markets are not chaotic systems in the way people imagine. They're structured systems driven by liquidity, leverage, and reaction. One of the most important mechanisms behind rapid drops is something called forced selling. Here's how it works in simple terms. A large number of traders don't just buy assets with their own money. They borrow money to increase their position size. This is called leverage. Leverage can amplify gains, but it also amplifies losses. When prices start to fall, leveraged traders begin hitting thresholds where brokers automatically close their positions to prevent further losses. Those forced sales push prices down even more, and that triggers the next wave. This chain reaction is known as a liquidation cascade. It's not a conspiracy. It's not a glitch. It's a built-in function of modern markets. Once it starts, it can move very fast. And that's exactly what we saw. Why gold and silver are especially sensitive. Gold and silver occupy a unique place in the financial system. They're not just commodities. They're also monetary assets. That means their price reacts not only to supply and demand, but also to currency movements, interest rates, and global risk sentiment. When conditions change in those areas, metals can move quickly. And one factor, in particular, plays an outsized role: the US dollar. The relationship most investors ignore. If you want to understand gold, you have to understand the dollar. Because gold is priced in dollars, the strength of the dollar directly affects the metal's price. When the dollar strengthens, it takes fewer dollars to buy the same ounce of gold. That often pushes gold prices down. When the dollar weakens, the opposite happens. This inverse relationship has been observed for decades. And today, one of the key drivers of the drop was a sudden strengthening of the dollar index. Now, why would the dollar strengthen so quickly? That brings us to the next layer of the story. Interest rates and expectations. Financial markets don't just react to what happens today. They react to what investors think will happen tomorrow. And one of the biggest influences on those expectations is the Federal Reserve. When investors believe interest rates will remain high or rise higher, the dollar often strengthens. Why? Because higher rates make dollar-denominated assets more attractive. Investors around the world move capital into US bonds and other instruments to capture that yield. That increases demand for dollars. And when demand rises, so does the dollar's value. Today, renewed signals that interest rates may stay elevated longer than expected contributed to a shift in currency markets. That shift spilled over into metals. Why silver often moves more than gold. Another detail that confuses many investors is why silver sometimes falls faster than gold. The reason is structural. Gold is primarily a monetary metal. Its price is driven largely by investment demand and central bank activity. Silver, on the other hand, has a large industrial component. It's used in electronics, solar panels, and manufacturing. That means silver reacts not only to financial conditions, but also to expectations about economic growth. When investors become uncertain about industrial demand, silver can move more sharply than gold, both up and down. And that volatility can amplify market reactions. The role of market psychology. Now let's talk about something just as powerful as economics. Psychology. Markets are driven by people, and people are driven by emotion. When prices rise steadily, confidence builds. Investors begin to feel comfortable taking larger risks. But when prices fall suddenly, that confidence can reverse very quickly. Fear spreads faster than optimism. And in fast markets, fear can trigger decisions that reinforce the move. More selling, more volatility, more panic. This is why sharp corrections often feel more dramatic than rallies. What experienced investors watch instead, while many investors focus only on the price chart of gold or silver, experienced traders watch a broader set of indicators. Currency strength, bond yields, interest rate expectations, global economic data, these factors often move before metals do. And when you start watching those signals, price movements begin to make more sense. Instead of looking random, they look connected. Why drops don't always mean the trend is over. One of the biggest mistakes new investors make is assuming that a sharp drop automatically signals the end of a trend. But history shows that markets rarely move in straight lines. Even strong long-term trends include sudden corrections. Sometimes those corrections are driven by fundamentals. Sometimes they're driven by positioning and leverage. Often, they're a combination of both. The key point is this: a correction tells you that something changed in the short term. It doesn't automatically tell you what will happen in the long term. That requires deeper analysis. What we need to look at next, so now we understand the mechanics of the drop. A stronger dollar, interest rate expectations, forced liquidations, market psychology, but there's still an important question left to answer. Why did this happen now? Why this week and not last week? Why this hour and not yesterday? Because timing in markets is rarely random. And in the next chapter, we're going to look at 3 specific forces that lined up at the same time, creating the perfect conditions for a rapid move in metals. And one of those forces is something most retail investors don't even realize they should be watching. In the first part, we explain the mechanics behind a fast market decline, leverage, currency strength, and investor psychology. But mechanics alone don't explain timing. Markets don't move this sharply without a catalyst, something that changes expectations quickly. And in this case, 3 forces lined up almost at the same time. Each one alone could have caused volatility. Together, they created the perfect conditions for a sudden drop. Let's break them down one by one. Force number 1, the Federal Reserve and interest rates. The first and most powerful factor is the Federal Reserve. Whether someone invests in stocks, bonds, crypto, or metals, the Fed influences everything because the Fed controls the cost of money. When interest rates are high, borrowing becomes expensive. Spending slows down. Investments that depend on cheap money become less attractive. But there's another effect that matters even more for gold and silver. Higher interest rates make government bonds more appealing. Think about it this way: gold doesn't pay interest, silver doesn't pay dividends, but treasury bonds do. So when bond yields rise, some investors move money out of metals and into bonds. Not because they suddenly dislike gold, but because they see a better short-term return elsewhere. That shift in capital can push metal prices lower. Recently, signals from Federal Reserve officials suggested that interest rates may stay higher for longer than markets previously expected, and markets react quickly to expectation shifts. That's what we saw. The dollar strengthened. Bond yields rose. Metals felt the pressure. Force number 2, global economic signals. The second force came from outside the United States. And this is something many retail investors underestimate. Precious metals are global markets. That means economic data from Europe, China, and other major economies can influence prices just as much as news from Washington. Recently, several reports indicated slowing industrial activity in key regions. Why does this matter? Because silver, in particular, depends heavily on industrial demand. Silver is used in electronics, solar panels, electric vehicles, semiconductors. When manufacturing slows, demand projections change. And when projections change, traders adjust positions quickly. That adjustment alone can create selling pressure. Even before real demand changes, expectations alone can move markets. And that's exactly what happened. Force number 3, uncertainty and risk sentiment. The third force is less visible, but often just as powerful. Uncertainty. Markets dislike uncertainty more than almost anything else. When investors feel confident, they take risks. When they feel uncertain, they move towards safety and liquidity. That often means holding cash or short-term government securities. Recent political and economic uncertainties, both in the US and globally, have increased caution among large institutional investors. And when institutions reduce risk, they often sell positions across multiple asset classes at the same time. That broad risk reduction can accelerate price moves, not because fundamentals suddenly collapsed, but because large amounts of capital move quickly. Why moves happen so fast today? There's another reason modern market moves feel faster than they used to. Algorithms. A large portion of trading today is executed by automated systems. These systems react instantly to price levels, volatility spikes, currency movements, economic data. When certain thresholds are reached, orders are triggered automatically. That can amplify moves dramatically. What once took days can now happen in minutes. And that's why sudden drops today often feel more violent than in the past. What experienced traders look for during a drop? Here's something important. Professional traders don't just watch price during a decline. They watch behavior. They ask questions like, is volume increasing or decreasing? Are bonds moving in the same direction? Is the dollar still rising? Are central banks making statements? Because the answers to those questions tell them whether a drop is likely to continue or stabilize. And right now, those signals are mixed, which means uncertainty remains high. The pattern markets follow after sharp moves. History shows that after sudden drops, markets usually move into one of three phases: stabilization, continued decline, or recovery. But one thing is almost always true. Volatility doesn't disappear immediately. After a sharp move, markets often remain unstable for days or even weeks as investors reassess positions. That's normal behavior. The mistake many investors make during periods like this, one mistake becomes very common. Investors focus only on what already happened. They stare at the drop, replay the chart in their minds, and ask, why didn't I see this coming? But that question doesn't help. The more important question is, what signals should I watch next? Because markets are always forward-looking. The past explains. The future pays. The signals that matter now, right now. There are 4 indicators that traders across the world are watching closely. First, the US dollar index. If the dollar continues strengthening, metals may remain under pressure. Second, Treasury yields. Rising yields usually mean stronger competition for gold. Third, global economic data, especially manufacturing and energy demand. Fourth, Federal Reserve communication. Even small changes in tone can shift expectations quickly. These 4 signals form the compass that many professionals use. Why corrections often shake out weak positions? Sharp moves also serve another function in markets. They remove fragile positions. Traders who entered late with heavy leverage are often forced out during volatility. And after that process finishes, markets sometimes stabilize because selling pressure decreases. This process isn't personal. It's structural. Markets constantly transfer assets from short-term traders to longer-term investors. And this process repeats over and over again. The question everyone is asking, so now we reach the question everyone is asking. Was this just a correction or the beginning of something bigger? The truth is, nobody can answer that with certainty. But there are ways to estimate probabilities based on evidence. And that's what we're going to examine in the final chapter. Because there are several scenarios that could unfold next, and understanding them will help you interpret what happens in the coming weeks instead of reacting emotionally. At this point, we understand what caused the drop: a stronger dollar, higher interest rate expectations, global economic concerns, and rapid liquidations in leveraged positions. But understanding the past is only useful if it helps us think clearly about the future. Because right now, the most important question isn't what happened, it's what happens next. And to answer that, we need to think in probabilities, not predictions. Markets don't move on certainty. They move on scenarios. Let's walk through the 3 most realistic ones. Scenario 1. Stabilization and gradual recovery. This is the most common outcome after sharp corrections in strong markets. Prices stop falling. Volatility decreases. Investors begin cautiously re-entering positions. This phase often feels quiet compared to the drama of a crash, but it's where trends are rebuilt. What would support this scenario? A stable dollar, bond yields leveling off, no major economic shocks. If those conditions appear, metals could gradually recover rather than rebound sharply. Not a dramatic rally, but a steady climb. Historically, many corrections in this way. Scenario 2. Continued volatility. The second scenario is that volatility continues. Prices may move up and down sharply for weeks as markets digest new information. This happens when investors are uncertain about interest rates, economic growth, or geopolitical developments. In this environment, markets often trade sideways with large swings. For investors, This can feel frustrating because there's no clear direction, only noise. But this phase is also common after rapid moves. Markets need time to reset. Scenario 3. A deeper correction, the third scenario, is less likely, but still possible. If the dollar continues rising significantly, or if economic conditions weaken more than expected, metals could face further downside. This doesn't mean long-term fundamentals are broken. It simply means markets may need to adjust to a new environment before finding a bottom. And historically, deeper corrections have happened even during long-term bull markets. Nothing moves in a straight line. What experienced investors are watching now, instead of trying to guess which scenario will happen, experienced investors watch signals. Because signals change before trends do. Right now, the most important ones are the dollar index, treasury yields, inflation expectations, and central bank communication. These factors will tell us far more than daily price movements. Prices are the result. These indicators are the cause. A lesson most people learn too late. There's something every investor eventually realizes. Markets reward patience more than speed. Many people believe success comes from reacting quickly, buying or selling the moment something happens. But in reality, reacting emotionally is often the fastest way to lose money. The investors who perform best over time are usually the ones who observe, analyze, and act only when they understand the situation clearly. That discipline matters more than any single trade. Why volatility is part of every market? It's important to remember something fundamental. Volatility is not a malfunction. It's a feature. Markets move because information changes, expectations change, and capital moves. Without volatility, there would be no opportunity, only stagnation. And every major trend in history has included sharp corrections along the way. The stock market, oil, gold, even government bonds, all of them experience sudden moves. It's part of how price discovery works. The psychological side of investing, one of the hardest parts of investing, is an analysis. It's emotion. Watching prices fall, even temporarily, can create stress, doubt, and fear. And those emotions often lead people to make decisions they regret later. The challenge isn't predicting markets perfectly. The challenge is staying rational when everyone else is reacting emotionally. That's what separates long-term investors from short-term speculators. Here's a useful way to think about market movements. Imagine looking at a chart from 5 years ago. What once felt like a dramatic crash often looks like a small dip in hindsight. That doesn't make volatility easier in the moment, but it reminds us that markets operate on different time horizons. Short-term movements feel huge. Long-term trends tell the real story. What this means for viewers, so what does all of this mean for you, watching right now? It means understanding is more valuable than reaction. When you understand why markets move, you stop being surprised by volatility. You stop chasing headlines. You stop making impulsive decisions. And you start thinking like an analyst instead of a spectator. That shift alone changes everything. Right now, global markets are in a period of transition. Interest rates are higher than they were a few years ago. Inflation remains a concern. Central banks are cautious. And investors are adjusting to a new financial environment. These changes create uncertainty, but they also create opportunity for those who stay informed. Because every new cycle produces winners and losers. And the difference is usually knowledge and discipline, not luck. If there's one thing to remember from this video, it's this. Sharp market moves feel dramatic in a moment, but they rarely happen without a reason. When you look beyond the headlines and understand the forces behind the movement, the picture becomes clearer. And when the picture becomes clearer, decisions become calmer. That's the real advantage. What do you think caused the biggest impact on metals this week? Interest rates, the dollar, or global demand? Let me know in the comments. And if you want clear, straightforward breakdowns of markets and the economy, subscribe to DollarScope. Because understanding the system is the first step to navigating it.